So if you're actively involved in investing, I mean, whether you're managing a big portfolio or just, letting your 401k do its thing, you're definitely familiar with the technical stuff.
Oh yeah, diversification, compound
Yeah.
interest, asset allocation. We hear those terms all the time.
Constantly. But today, for this deep dive, we want to talk about something else. The fact that even the most perfect strategy on paper can be completely derailed by just one thing.
The person, the human being holding the investment.
Exactly.
And that's the hard truth, isn't it? Today, we're shifting gears, moving entirely into the, let's call it the human side of financial advice. Because a strategy that looks pristine on a whiteboard often just fails in the real world.
Why, though?
Because clients can't stick to the plan when things get uncertain. Our sources really push us into this field of behavioral finance, which is this necessary but complex bridge between the hard numbers and our deeply messy human psychology.
Yeah, and we've gathered research that just confirms this over and over. Financial decisions are almost never made with pure logic. They're shaped by our fears, our past experiences, assumptions, and these powerful biases that are often subconscious.
Right.
I mean, think about it. Why would two people with the exact same net worth, the exact same portfolio, behave totally differently when the market drops?
Their emotional capacity, their ability to actually handle that risk is not the same.
And that realization, well, that's our mission for today. We're going to unpack 7 of these really powerful psychological tendencies that undermine rational long-term success.
And maybe more importantly, we're going to look at the toolkit that financial professionals use to try and combat these very human flaws.
Yeah.
Because if you can understand these biases, you can anticipate them.
And hopefully prevent that emotional sell-off. Okay, let's unpack this. We really have to start with the biggest one, the most influential factor, the psychological bedrock of panic, which is loss aversion.
Loss aversion. It's this core concept that the pain you feel from a financial loss is, psychologically, about twice as powerful as the pleasure you get from an equivalent gain.
Twice as powerful.
It fundamentally warps how we see volatility.
And you see this so clearly with clients, right? I mean, the same person might be, satisfied with a 5% gain in their portfolio. It feels like a nice little bump.
Yeah, it feels good.
But they will be profoundly emotionally devastated and just anxious if that portfolio falls by 5%. The dollar amount is identical, symmetrical, but the emotional reaction.
It's completely asymmetrical, and that asymmetry drives irrational action. The pain threshold is so low that clients feel this compulsion to just sell everything during a downturn.
It's just to make the feeling stop.
To stop the feeling of loss. And in doing so, they lock in the very loss they were trying to avoid. Or, on the other side of it, they might avoid taking necessary, moderate risks in the first place, which just cripples their long-term growth.
So the advisor's job isn't just managing money. It's more like being a behavioral coach. How do they actually do that? How do they mitigate that pain response?
It's all about focusing on discipline over reaction. A really practical strategy is using automated investment schedules. You pre-commit to investing a certain amount monthly or quarterly.
So you take the emotional decision out of the equation.
You remove it entirely. You're systematically buying assets no matter the current price, which prevents that fear-driven should I or shouldn't I moment. Suddenly, volatility stops being a personal emergency, and it's framed as just a normal, expected part of the long journey.
Okay, so if loss aversion is all internal, the next bias we're looking at is intensely external. Let's talk about herd behavior. We're just, we're wired to seek safety in numbers, and that definitely applies to money.
Precisely. Clients feel safer, they feel validated when they're moving with the crowd. The problem is the crowd is almost always wrong at the market extremes.
So this leads to chasing trends.
Chasing trends, buying into those hot investments right at their peak, or abandoning a perfectly sound personalized strategy just because everyone else is panicking and selling.
This isn't just a small mistake, right? This is the very mechanism that makes market swings even worse.
It is. Herd behavior accelerates the cycle. When people are excited, they all flood in, driving prices up artificially. When they get scared,
They all rush for the exit at once.
simultaneously. And this constant poor timing, this pattern of buying high and selling low, is often the single biggest thing that drags down long-term returns.
So how does an advisor anchor their client when the news, their friends, social media, everything is screaming about the next big thing or the impending crash?
They have to constantly bring it back to the client's documented personal plan.
Yeah.
They remind them of the specific goals they're saving for, that down payment, that retirement date. The advisor uses that plan as sort of the immovable object against the force of all that market noise.
The focus has to be on the long term.
Always long-term horizons, not the short-term excitement or fear of the crowd.
Here's where it gets really interesting, because now we're shifting into these deep individual biases, starting with ego. Let's talk about overconfidence.
Overconfidence is so dangerous. It shows up as this belief that the client has some kind of, superior innate skill, that they can consistently time the market or pick winning stocks.
That they're the exception to the rule.
They see themselves as the exception, yes, despite all the evidence to the contrary.
But hold on, isn't some self-belief a good thing for investing? Where's the line between, say, healthy confidence and destructive overconfidence?
That's a great question. Healthy confidence means you stick to your diversified plan even when things get volatile. Destructive overconfidence means you abandon that diversification because you think you found the one magic stock that's going to solve everything.
And that ego bias leads straight to what?
Concentrated, undiversified positions.
Yeah.
And taking on risk levels that are just completely unnecessary for reaching their goal.
So the advisor's role here is a kind of tactical intervention.
It is. They have to provide a strong dose of reality. And it has to be backed by data.
Yeah.
They show the client that, look, even full-time professional fund managers, people who do this for a living, struggle to consistently beat the overall market over decades.
Right, they bring it back to earth.
They set realistic expectations based on probability and history, and they gently move the client away from a gambling mindset and back toward, prudent management.
Okay, so moving from ego to fixation, let's talk about anchoring, the reference point trap.
Anchoring. This is when a client gets fixated on an arbitrary number. Most often, it's the original price they paid for an asset. And they use that number as the only reference point for making decisions.
Regardless of what's happening now.
Regardless of its current market value or its future potential.
Can you give us a concrete example of how this just destroys value?
Sure. Imagine a client bought stock X at $100 5 years ago. Now it's trading at $50. The company's fundamentals have changed. It's a poor prospect now. Logically, they should sell it, redeploy that capital somewhere better.
But they can't.
They can't because they're anchored to that $100 purchase price. They'll say, I have to wait until it gets back to what I paid. And they end up holding on to this dead weight forever just to avoid making that paper loss real.
I think the key insight there is that investment decisions have to be purely forward-looking. The price you paid in the past is its history. It's irrelevant to what that asset might do in the future.
Absolutely. The decision has to be about suitability and long-term outcomes based on today's information, not yesterday's regret.
Next up is recency bias, which is all about this sort of temporal distortion. This assumption that whatever trend is happening right now, whether it's good or bad, is just going to continue forever.
And this one is pervasive. If the market's been climbing for 3 years, clients get overly optimistic. They start extrapolating that climb into infinity, and they want to shift into riskier assets because, the recent past looks so calm.
And the opposite is true, too.
Exactly. After a sharp, say, 18-month correction, they become overly pessimistic. They think the market is fundamentally broken, and they want to shift everything into cash.
They just lose all historical perspective.
They do. So the advisor has to step in and provide that perspective. They remind clients that markets move in cycles, not straight lines. They show them historical charts that demonstrate that recent performance is actually a terrible predictor of the future. It grounds them in the reality that volatility is normal, not terminal.
Okay, so that covers the 5 core biases around valuation and ego. But there are 2 more really crucial psychological factors that kick in, especially during stressful market periods. Let's talk about the anxiety factor. Lots of control.
When volatility hits, everything feels chaotic. A client feels fundamentally powerless over these huge external events. And this feeling of helplessness, it spirals into anxiety.
And that anxiety creates this intense, overwhelming desire to just do something.
Do anything, even if the best course of action is to be patient and do nothing at all.
I can relate to that. Checking prices at 3 in the morning during a big dip, that is pure loss of control anxiety right there. So the advisor's job is to restore that sense of control, but not by trading.
Exactly. They substitute that urge to trade with the ability to understand. Structured, regular reviews, clear communication. These things help clients see why their portfolio is behaving the way it is in the context of their overall plan. When clients feel they have that intellectual control, they are far less likely to panic.
And our final bias is confirmation bias. This mental filter we all use to screen information, and it seems to work overtime when money is on the line.
Oh, it's insidious. Clients will actively seek out news or analysis or social media comments that support what they already believe.
Especially if they've taken a risky or concentrated position.
Yes. And at the same time, they will conveniently ignore or dismiss any alternative viewpoints or, any contradictory evidence.
Which leads to very unbalanced decisions and this real resistance to making necessary changes that an advisor might be recommending.
If we connect this to the bigger picture, the advisor has to be that objective, external voice of reason. They have to challenge assumptions and encourage balanced thinking by presenting clear, factual information that might directly contradict the client's preferred story. It requires a lot of trust, but it's essential for moving from emotional reactions to rational choices.
And this brings us perfectly to the core of the strategy. If these psychological traps are always there, how do professionals actually apply behavioral finance? What's in the advisor's toolkit to keep clients on track?
Well, we have to reiterate that a technically perfect strategy is completely useless if the client won't commit to it, especially during a downturn. So the whole goal of the toolkit is to enforce stability and structure.
Okay, let's start with stability. We mentioned diversification earlier, but can you tell us how it works primarily as a behavioral tool?
Think of diversification as financial shock absorption. It dampens the impact of extreme market swings. When those swings are less severe, the client's loss aversion trigger is just less likely to go off.
It reduces the impulse to panic sell.
Right. It's a mechanism that's literally designed to protect the client from their own fear.
And what about the role of the structured review? How does that fit in?
Regular structured reviews, they reinforce discipline. They normalize the whole process. Just sitting down with a client, looking at the long-term data, and seeing that the plan is still on track, even after a correction, that provides deep reassurance.
It shifts the focus away from the daily noise.
Exactly. It shifts it back to the agreed-upon, distant goal. It makes the client feel supported and, accountable to the plan they helped create.
So structure and stability are key, but let's talk about communication. It seems just as important for battling that anxiety we talked about.
Absolutely. And the communication has to prioritize clarity over complexity. Clients don't need to be investment experts, but they do need to understand the fundamental purpose of every investment. They need to understand how risk works in their portfolio and, critically, why volatility is a natural, expected part of the journey.
That clarity builds confidence.
It does. It reduces the fear of the unknown.
And our sources really emphasize that transparency builds trust, and that trust acts as the ultimate psychological anchor. It allows them to ride out those periods of real uncertainty.
That is the essential ingredient. But probably the most practical and sophisticated tool in the whole toolkit combines two distinct assessments. It goes way beyond simple questionnaires. It's risk profiling combined with a capacity for loss assessment.
Okay, so most of us are familiar with standard risk profiling. That's the questionnaire that measures your willingness to take on risk. I feel comfortable with market fluctuations.
Right. And willingness is important, but it's often really flawed because clients are always brave when the market is going up.
Right.
Capacity for loss assessment adds these essential financial and psychological layers on top of that.
Can you walk us through how those differ in practice?
Certainly. Financial capacity for loss measures how much a client can afford to lose without it derailing their actual life goals.
Yeah.
Psychological capacity for loss measures how much they can emotionally withstand before they panic and sell.
So you could have someone who can afford a big drop, but can't handle it emotionally.
That's the key conflict. We might have a client with high financial capacity. They can afford a 40% drawdown on paper. But if their psychological capacity is only 15%, and the portfolio is designed for that 40% risk,
they're going to sell at the 16% mark and cause a disaster for themselves.
Exactly. So the crucial insight here is that a suitable portfolio has to align not just with their goals and their theoretical willingness, but with their true psychological ability to stomach the ride.
The maximum possible return is totally irrelevant if you can't actually hold on to the investment when stress hits.
The professional's job is to make sure that portfolio is always positioned below the client's psychological breaking point. The optimal strategy isn't the highest possible return. It's the highest return they can tolerate without triggering a behavioral failure.
So what does this all mean? We've covered 7 critical psychological biases, from loss aversion making us want to sell low to overconfidence pushing us to take on too much risk. The synthesis is just. It's absolutely clear. Investing is a human endeavor.
It is. At the end of the day, clients are looking for security, for stability, and for clarity, especially when the world feels uncertain.
The role of the financial professional today has just broadened so dramatically. It's not just about optimizing the technical returns anymore.
No, it's about combining that technical knowledge with deep emotional insight, with behavioral coaching. It's about designing a plan that doesn't just look perfect on paper, but that the human being attached to it can actually follow when they're under pressure.
So the ultimate measure of a robust financial plan isn't its mathematical perfection, but whether it's truly aligned with your psychological ability to stay invested during those really challenging periods.
Which leads to the final thought. If a portfolio is specifically designed and calibrated to prevent panic before it even starts, what does that realization change about how you view market fluctuations the next time the news turns negative? It's the real deep dive for you to consider.